We certainly make our own calculation of risk versus reward in every transaction we do. And it's true whether it's marketable securities, that's true whether it's private investments, that's true whether it's making an investment in a business. And sometimes we're wrong, and we're going to be wrong sometimes in the future. You can't make a lot of decisions in this business without being wrong, but we don't think the procedure or the results would be changed favorably by having lots of committees and lots of spreadsheets and that sort of thing. It just, if I had a group under me, they would try and figure out what I wanted the answer to be, and they would tell me what I wanted to hear. And I've watched that approach at 20 public companies, and what the CEO wants to do, they may spend a lot of time getting there, but the investment banker gets there, and the internal committees get there, or the internal operations get there. The calculations are it's the same as the insurance business with a G. The G gets calls on insurance deals, and you have to think through that deal. The main thing is, are you reasonably sure that you know what you're doing? And it gets past that hurdle, then we go on to figure out the math of gain versus loss and how much loss we can afford to take in anything. And we're willing to take what sound like large losses if we think that the rewards are more likely and proportional. It's very disappointing. We have no formulas around Berkshire. We don't sit down and write a bunch, have people work till midnight calculating things and putting spreadsheets together. And if the hurdle rate is 15% or something, having them all come out at 15.1 or 15.2, because that's what's going to happen. I mean, you're going to get the numbers you want to hear to an extreme degree.
Yeah, we don't formally have discount rates. I mean, every time I start talking about all this stuff, Charlie reminds me that I've never prepared a spreadsheet. But I do, in effect, in my mind, I do. But we are going to want to get a significantly higher return, obviously, in terms of cash produced relative to the amount we're outlaying now for a business than we are from a government bond. I mean, we're going to that has to be the yardstick at a base. Then how much more do we want? Well, if government bond rates were 2%, we're not going to buy a business to earn 3 or 3.5% expectancy over the years. We just don't want to commit our money that way. We'd rather sit around and wait a little while. We want enough so that we feel very comfortable if they close on the stock market for a couple of years. If interest rates go up another 100 basis points or 200 basis points, we're still happy with what we've bought. And above that, I really, I know it sounds kind of fuzzy, but it is fuzzy.